I just heard about a group out of Houston that got foreclosed on, a big group. I don't hear about many multifamily major foreclosures, but I feel like it's coming.
It is. Oh, yeah. I tell everybody, we're probably in the second or the third inning of a 9-inning game. In all seriousness, yeah.
So let's unpack that, because we're part of 2 multifamily deals as LPs, and both of them stopped the pref. And one of them was even considering a capital call, and we were pushing back on that as investors. We were kind of like, what the heck is going on over there? It was only supposed to be a 20-month turnaround or something like that. And it's turning out to be a lot worse than that. We're going to end up holding it for a while. And in order for us to get out of the current debt structure that we're in, there's probably going to have to come to the table or sell at a break even, maybe even a small loss. Who knows how this thing's going to play out? And I know a lot of people that are really nervous about the next 24 to 36 months. So what's your outlook on the commercial space with rates?
Sure. Well, so first of all, in the commercial space, you've got what I look at is I look at office, retail, industrial. I look at multifamily. I look at all the different classes, and I think that's important because each one's different. So like office right now is getting hammered, right? People are, their leases are renewing and they're downsizing or just not renewing or whatever. So you got this commercial debt side of the business, and the reason I bring that up is because these are the same people that finance multifamily. So, the Berkadia or CBRE or Walker Dunlap or whoever it is that you're going with, they're financing office, they're financing retail, they're financing multifamily. They have a whole portfolio and a whole allocation strategy. And the reason why that's important is because if a commercial office building is defaulting, which they're starting to, it affects that lender. And so they're, so everything's on watch right now, right? And the same thing on retail with direct to consumer and all that. Those are all potential issues. But specifically for multifamily, the real issues that people are going to have are if they have variable rate or bridge loans, or they did some kind of value add. When you said that, they're not paying the pref, it's still accruing. So the pref is still accruing. So even though the syndicator or the GP isn't paying it, it doesn't mean it goes away. So what a lot of times people forget is that there's a cost for the debt and there's a cost for the equity. The cost for the equity is called pref. The cost for the debt is called the interest rate. So, that's it. So there's a cost. So whether the property produces it or not, that's why I was telling you earlier, when I do my pref, I solve to the cash flow. So, so I'm making sure on day one that thing's cash flowing 5%, 6%. And that's why I don't have a standard deal. That's why I don't raise money at 8 or 9%, because why would I want to be negative? Why would I want to be behind that? I don't. So, so that's been our philosophy, is that the property should pay the pref. Now, if they can't pay the pref, it's probably as a result of the interest rate going up on their variable rate loan. And that's actually the big issue that a lot of people are having, and not just in multifamily. So we had 6 deals that we were doing, by the way, we owned already. So they're internal deals. There weren't things that we went out and syndicated on, but they were deals that we did a cash out refi, and we're putting the money back into the property, and we're growing the rents again. So I have properties that I've owned over 15 years and we've refinanced 3 times. So, but you would do it at a variable rate. And some people would ask, well, why would you do a variable rate? Well, because you don't want to put a fixed debt on something that is undervalued. So you do a variable and then you put a bunch of money into it, just like I was saying before in that 230 unit. So it's the same thing. So you wait until you've actually proved out all the value, then you put the fixed rate debt on it. So all the people that are caught between the fixed rate and the variable rate, they're the ones that are in trouble. And the other side of that is that cap rates are also going up. So as interest rates go up, cap rates go up. So if a capitalization rate is 4% when they bought, or like everyone a year ago, let's say, and they've gone to 5, that means that your property is worth 20% less. If you take your same NOI and you divide it, 4 to 5 is 20%. So that's a 20% loss of value. Now it's just in paper. it's irrelevant unless you have to